Hello, today is Saturday, July 28th, 2023. I'm Jason Shapiro with crowdedmarketreport.com. Today I was going to get a little bit into something I don't do a lot, but I'm going to try to develop sort of a macro thesis here. And I know I'm so anti-macro, and I say it all the time, the macro will kill you. But the way I try to develop the macro is a little bit different. I don't have spreadsheets of data in my forecast in front of me telling me what the macro is going to do, because I do think that's useless. But I try to look at general psychology, general consensus, and positioning to try to determine what the sort of contrarian idea is, because I find that happens quite often. And it starts with the market. So here's where people are crowded in the market. So the market's probably going to do this. And if it does that, then what is that going to mean for the macro, or at least for what people are thinking about the macro and how that will change? So that's kind of how I go about this. So just to take it back, the last time I really talked about this was back late last year, when people were coming into 2023, and it was just clear what the consensus was then, which was that we were going to go into recession the second half of this year. The stock market was going to go down the first half of this year, anticipating that recession. And then the second half of the year, the stock market was going to go up, anticipate coming out of that recession. And so clearly the contrarian idea was be long the stock market, right? And wait until the consensus got off the recession thing. And I thought what could happen, forgetting about the market for a while, I kept hearing interviews with CEOs who were talking about the fact that they were preparing for the coming recession. Well, what does that mean? It means they're not investing as much, just like people who are preparing for the stock market to fall are short. People who are expecting the economy to fall are essentially short in their business. And that if they came into this short and then recession didn't happen, well, then they, just like stock market investors, they were going to have to try to catch up. Stock market investors will chase the market up, although we haven't seen that much yet, but they will need to chase the market up, and CEOs of companies will need to chase the economy up. So they prepared for recession. They were going to make 1 million units. Well, it turned out recession never came. They sold 1.5 million units. So what are we going to do? We have to ramp up production. And I think that's the stage we're getting into now, and we're seeing that in the data. The GDP data is coming out stronger than expected. The earnings and the revenues of most companies are coming out stronger than expected. And I know people will argue, well, that's because the expectations were lowered so much. Yes, because people thought recession was coming, but the actual numbers are coming to the numbers where the analysts had it before they thought recession was coming, right? And so that's what's happening, right? Now we're in the middle of that. So there we are. So where do we go from here? And if this is the case, I think this is where, and based on, again, positioning and then general psychology, I think the case is that we start to see the economy to continue to grow stronger than people think. And at some point, it becomes like this Goldilocks thing, which is exactly what we saw in the numbers this week, right? Where the growth is there, it's solid, and inflation has come down. And you can say inflation has come down because the Fed's raised, a whole bunch. But I would kind of argue that the biggest part of inflation, people seem to forget this, but if, during COVID and right after COVID, we kept hearing about all these things that were going on, like in shipping. The LA ports were backed up because there were no truckers to take the stuff off the ships and truck them around the country, and the trains, there weren't anybody to run the trains and all this. And so the whole thing got messed up, and that was obviously inflationary, and that's now, dissipated. So the inflation has also come down. So we're in this sweet spot where inflation has come down a lot. Growth is higher than expected, and that's sort of Goldilocks-y, right? So, but we haven't seen the kind of short covering in stocks that we really need to see for people to completely capitulate. And we haven't seen the bears capitulate. There was this Mike Wilson thing last week where everyone said he capitulated, which he didn't capitulate. He said that he was wrong the first half of the year, and he admitted that, but now he thinks the S&P is going down to 3,900. That's not capitulating your bear view, I'm sorry. And other bears, I watch them and I listen to them. They have not capitulated. So what could cause this capitulation is if we continue to see this growth with lack of inflation, we're in this Goldilocks, and then people can then capitulate, say, oh, here we go. We got growth. And they will capitulate and get long the stock market. And then, of course, we can talk about shorting it, but this seems like it's pretty still far away. Probably going to take at least the whole second half of the year, it seems to me at this point. And it's an interesting thing that's going on with the Fed, too, on top of it, because they've been raising rates. We know that. What are they raising? 5.5 or whatever, 5.25 over what they were. And yet the 10-year rates are going down, ever since really here, which was like late October of last year. This is the 10-year note going up, which means 10-year rates are going down, because the Fed controls obviously the front end of the curve, right? The Fed funds rate. But the back end of the curve discounts in the future of inflation and the future of growth. So as the Fed raises rates, the 10 years and the longer end, this is why we see such an inverted curve, right? Has been discounting in this recession. So where do people borrow money? I mean, companies for the most part borrow in the 10-year place. So 10-year rates maybe what? 1.5% before this whole thing started, and now they were at 3.5%. They're closer to 4% now, but as of a couple weeks ago, they were at 3.25% to 3.5%. So if companies are borrowing at 3.5%, is that really slowing things down? And individuals, borrow really at 30 years because they're borrowing against their house, they're doing home equity loans, and 30-year rates haven't really gone up that much. So this is not slowing down the borrowing and the growth. And so the ironic thing, of course, will be, when will the long end rates go up? And the answer is when the Fed stops raising rates, because then the long end could start discounting on the idea of, oh, well, they're not raising rates no more, so we can start getting inflation and growth and all that. And then the long end of the curve will go. And we'll see move out of the inversion on the yield curve to what's a normal yield curve. And then, of course, right as people were saying, there's growth, the economy looks great, and they're getting along, then the whole idea of, well, now real interest rates, the long end of the interest rates, which is really where people operate, are going to start to stop it. And that's going to be when we get the recession, okay? And that, to me, seems like a good year away at least, which is about as far out as anybody goes. People have now pushed their second half of this year recession calls to the first half of next year, and possibly the second half of 24. So I think it's going to be further out than they think. At the very closest, the furthest out they think, which would be the second half of 24. And that's kind of the cycle as I see it. So basically, things are going to keep going up as growth is stronger than expected. People are going to buy into the Goldilocks thing. They're going to get too long, and then the long end of interest rates is going to go up, right? Meaning long rates are going to go up, which actually will slow the economy. And then we'll get the recession, and then we'll get the stock market. So that's kind of how I see it. It will be interesting to look back on this in a year, 6 months to a year, which I like to do because I'm no macroeconomic economist. This is just a classic sort of let's be as contrarian as we can based on positioning, based on psychology, and see if that works. The first half of this year, that seemed to have worked. Let's see how it does the second half. Let's see how it does next year. And let's see how things change if I am able to pick that up as well. Okay? So I hope that all makes sense. I always welcome questions and comments. And we would love to see you on crowdedmarketreport.com. All right. Thank you. And I hope you all have a profit.